All right, ladies and gentlemen, welcome back to another episode of the Market MadHouse Show. My name is Cyprian Francis, and with me, as always, one of my good friends, co-founder of Madison Trading House, Mike Patton. Good morning, Mike. How are you?
I'm doing great, Sip, and good morning, everyone. Hope everyone's doing good.
And today's morning is starting off with Fed Chairman Powell in front of the Senate Banking Committee, trying to explain why they raised the 0.75 basis points.
Right.
Um, have you been watching that? Any ideas? Any feedback? The market seems to be rallying from that news. So, what are your thoughts?
Well, basically, the market is rallying from that news. One of the things that Powell actually said that was very important during that meeting, or his hearing, is that he said that there's no need for the Fed to induce a recession in order to calm inflation. Now, that was a big fear because a lot of people were afraid that the Fed was going to deliberately cause a recession in order to quell inflation. Powell said, no, we're not. Part of the reason he said he wouldn't is something else that's actually interesting that he threw out there that I think a lot of people caught but never really thought about until now. He basically said, look, raising interest rates is not going to bring down oil prices and it's not going to bring down food prices. So just forget about it. And pretty much all the Fed can really do is raise rates or lower rates. I mean, they can't do that much more. So in short, he basically told everyone in no uncertain terms that, hey, we can't fix that problem. Good luck though. So now the markets obviously do like the fact that the Fed is telling them they're not going to do anything that might induce a recession. So the biggest fear right now in the market, unquestionably, is a recession. Everyone's scared of it, and for good reason, because we're basically, I mean, depending on how you look at it, and again, economists they'll say, well, after this many quarters of no growth, now we're in recession, whatever. But the point is, if you really look at the picture of the economy, I mean, we've been declining for some time now. So it may not show up on every metric, but I think on the street, where the rubber meets the road, I think everyone is aware of the fact that, hey, things aren't going so well. If you look at the polls, Americans overwhelmingly don't feel like the economy is doing that well. So you'll hear the politicians say, "Oh, yeah, we're got unemployment, all this other stuff," but people see the reality of it, and now we're starting to see these layoffs coming in. So it's pretty obvious that yeah, things are not working out so well as they claimed.
Yeah, and a few of the senators brought up the fact, or at least, questioned that the US isn't the only one dealing with these problems, right? Other parts of the world are seeing the same inflation. And so to pinpoint it on what's happening in America isn't really telling the whole story. This is a global issue. Different economies are going to have to raise rates at different, pace. And so, what are you seeing from a global perspective that's impacting everything?
Well, that's a
Obviously,
great
oil in China, because we've been talking about that for quite some time.
right. So it is a global phenomenon. It's not just here, and I mean, but this all makes sense because if we look at the global financial economic system, it's all so intertwined, and it was done deliberately. Globalization, the idea was the more interconnected economies are, the more we cooperate with each other financially, the less likely we have war. Everyone's going to get along and be happy. And I mean, there's some truth to that. I would never deny that. But at the same time, it does bring consequences too. Lack of independence, more dependence on other places for things to work. Also, if one country raises their interest rates, it kind of makes it necessary for other countries to do the same. So when it comes down to it, the big factors obviously are the Ukrainian conflict. But I also would say it's not strictly the fact that there is a conflict, it's more how the conflict is being dealt with in policies and actions that are being taken to address it. So, sanctions, I mean, I have to agree with China on this one. I'm not a big fan of the Chinese. Okay, I'm not a fan of the Chinese government at all. I don't like the Chinese Communist Party, but at the same time, I have to agree with their statements about tariff, or sorry, about sanctions. That they're right. It's not, you can't do sanctions in a global economy and it just affects the target. It's going to affect everybody, right? So, and then what we greatly seem to underestimate when it came to Russia was that Russia's economy has been isolated for so long. They're not fully isolated. Don't get me wrong. They are a global country, but at the same time, there's been sanctions for so long and all this pressure on them. They've become very independent. I mean, they can make pretty much all the things they need right there from home, and their immediate trading partners like China and India, they're not having any issues with them at all. So the United States has never been the major trading, or Europe, except for energy for Europe. Um, Other than that, it hasn't been the major trading pack. Now, of course, energy is the big trading. If I'm correct, the majority of the Russian economy is energy exports. So, but it's not something that Europe can get away from anyway. So it doesn't matter how much they talk about it; they can't get away from it. So, in short, the Russian economy actually did better after this than it would have before, and that's the funny part. That they actually made more money. They were able to renegotiate things, maneuver around things, and pretty much keep their economies intact. But we are already having inflationary problems. It didn't get started with Ukraine. This stuff was happening over a year before. This just happens to be the one more big brick on the wall of what we've been building up as far as problems. So in short, globally, supply chains still have problems. China is locking down again. They have more outbreaks in different cities now. Shenzhen has a outbreak. Whether or not it's going to be a lockdown that gets close to what they've done with Shanghai and some other cities, we'll see. But that's a lingering problem, and part of that's because of how China's dealing with it. They want zero COVID. Well, if you want zero COVID, the only way you might be able to achieve that is to lock everyone up in their houses, which is exactly what they're doing. And of course, that means their productivity goes down tremendously. China is the manufacturing hub of the world. So with them locking down, that just puts more of a drag on the global economy. It makes things work worse for other places. With all this globalization, it's inevitable. If you cut off the engine over there, well, it may be over there, but it's affecting us here. So there's too many different things on top of the Ukrainian conflict, on top of the high oil prices, on top of the high food prices. They're all just converging into one big mess. And to me, it seems inevitable that the world economy is heading into recession. I mean, I don't see how we could possibly turn it around right now without a miracle. And with the Fed's comments, I think Powell was pretty clear about the fact that if anyone's expecting that miracle, it's not coming, from them.
Yeah, and a recession, there's variations of a recession. There's a deep recession, and then there's
Right.
a maybe we just slip into recession a bit and then recover, which after a pandemic that lasted 2 years, that doesn't seem too far off of like, hey man, we might need to slow some things down, cool off. So we're definitely going to have to keep an eye on these upcoming numbers, the GDP numbers, the employment numbers, the inflation numbers. They're really going to play an impact on the market. I
Right.
do see here on my notes that oil is slumping down nearly to $100 a barrel. So that's positive news. If we could stay there, that could help with the flatlining, I'm assuming.
I don't think it's going to stay there. See, I had a conversation with one of our members this morning, and I mentioned to them because they asked this question. They said, "Well, who's selling oil right now? Why would it come down right now when there's no reason for it to come down?" And I basically pointed out that look, oil's been trading in a very wide range, a very large price range, about $20 wide, since the start of the Ukrainian conflict. So all we're seeing is it go from one extreme to the extreme high to extreme low to extreme high. It's just going back and forth. It is not that there's some big oil sell-off. There isn't. It's just that sometimes you have people needing to sell and sometimes you have people needing to buy. We're never going to know why. Some people are selling because they are in the industry and they may need to offset some price risk. Other people might be selling because they see weakness in the price and they feel like they can make a profit. Others might be selling for other reasons. We don't know. It's not like these guys telegraph to us, "Hey, we're going to sell today," and just letting you know. They don't do that. So We just see it happen. All I tell everyone to look at is just look at the big picture. Do we have massive investment into oil infrastructure at this point? No, we're far behind. Venezuela is the best example. Venezuela has, if I'm correct, the largest proven oil reserves in the world, period. And they can barely get any of it out the ground. Why? Because their infrastructure is going to crap, and part of it's due to sanctions, and part of it's due to other reasons. But even if we ignore them, we look at the OPEC countries. A lot of them are far lagging behind on their investment into their infrastructure. Just like we look at the United States, we look at our infrastructure, like our highways and roads, et cetera. Everyone sees that things are kind of getting bad. I mean, roads are getting worse, bridges are collapsing, things like that. Why? Because infrastructure investment has been lagging behind. We've been putting our money into everything else but what actually keeps our economies running. Energy is the cornerstone of all modern economies. There is no way around it. Our economies would literally die if we didn't have availability of cheap, readily transportable energy in large abundance, which we do have, but it's becoming harder and harder to move it around because we haven't really invested into the infrastructure. So these are not things you can just snap your fingers and fix. And this is why it really it makes me kind of giggle when I hear these politicians talk like they can fix this stuff right away. It's like, no, you can't. It will take years to fix this stuff to get it up to prime condition. So therefore, the world's going to have to suffer through it, and that will keep prices of energies propped up. So even if everything settles down with Russia, even if everyone starts to give each other a hug, which would be great, but that's not going to change the fact that we're way behind on an investment into infrastructure. So it's just going to be a matter of whether or not we take it seriously enough. And I think that right now we kind of are, but my experience with this stuff is as soon as it's off of our minds, it doesn't exist anymore. And then later on, we all complain about why didn't we do something then? So we'll see.
Yeah. Well, one guy who I think is doing something about it is our main man Elon Musk over at Tesla. And so
Sure.
there's been some news around him, obviously Twitter, Tesla, SpaceX,
Mhm.
his transgender child, I believe, is now in the news.
It's all over.
Poor,
Everything's it.
poor guy. He can't catch a break. But
True.
the big news in terms of the stock this week was the announcement of some of the layoffs, and
Yeah.
so that kind of is bringing into discussion, the economic component of, all right, well, Tesla's laying off, some of the other tech stocks are going to be laying off,
Right.
and so let's go ahead and dive into what the Madison Trading House platform is telling us from all this news around Tesla. And before we dive in, let's just, anybody watching or listening for the first time, what you're seeing on the screen is the Madison Trading House, a fabulous analysis tool for quickly scanning stocks, getting insights into the technicals, the fundamentals, things like that. And if you're interested in test driving it, giving a look for yourself, we're going to go ahead and add a link into the chat. But during this section, what we like to do is Mike has a couple stocks that he likes to run through. We like to give the audience an opportunity to name some stocks that maybe they'd like to see run through the system as well. And with that being said, Mike, Tesla, I'm seeing 2 yellows, 2 greens from
Yep.
our previous discussions. That's usually a good sign. But what are your thoughts?
It is a good sign. It's not, yeah, and it is a good sign. Usually, it is a good sign now. All right. So, a couple things about Tesla we should point out. Firstly, layoffs. Tesla is laying off employees. The number is, I believe, 3.5% is of their total workforce, according to Elon Musk. Now, he did give a reason for this, and the reason to me actually makes a lot of sense. He's concerned about the economy, the future outlook of the economy, and he's basically saying we should move to cut some staff. I think that's a good move, to be honest. Now, if you're working for Tesla, obviously that's not good for you if you got laid off. And of course, I don't think that's trivial. But at the same time, a company is a company, it has to survive. And basically, if things are not looking so great, that's a good decision. Now, Tesla fundamentally is still a sound company. The software is detecting, firstly, that if we look at Tesla from a valuation perspective, meaning when people invest, For those of you who are not familiar with this, you have things like PE ratios, price to book ratios. These are ways to kind of see how the price of the stock relates to certain key metrics like book value, which would be assets that the company owns, or cash flow, money coming through the coffers that you can use for different reasons. Earnings, the amount of money that the actual company clears in profits. So when you measure the price in relationship to these things, you get a ratio, and that ratio changes as the price and the other metrics change. Now, the software has a unique feature that keeps track of all of those ratios over time. So it can figure out when those ratios are at high points or low points. So it's just like when you look at the price of a stock, if you only could see the price of the stock right this moment and you couldn't see what it's done before, you would have no context. So we could see, oh, Tesla's at $716. If that's the first time I ever saw the stock in my life and I had no idea what the price history of Tesla has been, I can't really tell if that price is high or low. Well, likewise, if I'm looking at any of these valuation ratios, if I have no idea how they've moved over time, there's no way I can know if it's a good value or a bad value. Or, so when we look at valuation, which I'm jumping into the detailed view now, we can look at the trailing price to earnings ratio, which means what it's been up until this point over the last 12 months. And then we can look at the forward price to earnings ratio, which is a projection into the future, but based upon the company and based upon analysts of where earnings are going to be in the future for this company over the next year. And they're both about the same. So basically, the market's projecting that you'll have a slightly higher, or slightly lower forward PE than the past. So that's the reason why I believe Elon decided with the company's leadership to lay off, because they're basically projecting that earnings are going to slump a bit from where they've been over the last 12 months. And if that happens, it does make sense to make that move. But that still means that on a value perspective, the stock's not very expensive. Compared to its earnings, it's actually cost a lot more in the past than it does now. I mean, there was a time, if you look on this screen, where the PE ratio for Tesla was at 1,724, which means that literally the stock price was 1,724 times the amount of earnings they were generating. Now it's at 69.97, much better, right? So that basically means that as time has progressed, Tesla's become more profitable, and that's been a way to justify the current price. And over time, as Tesla evolves into a more established company, eventually that PE ratio will probably drop to somewhere where Apple's PE ratio is. So the more established companies become, their PE ratios get lower over time. But when they're just developing and people see big potential for profits and growth of the company, they basically will trade a price that's justifiable if they're right about the future earnings. And they'll do it now because it doesn't make sense to wait. If you think you're right, you buy it now while it's still at a price that you think you can make some money off of. Anyway, so when we look at these ratios, we can see these lines on the screen. We're seeing the history there. So basically right now that line is towards the bottom of the recent range. So you can consider this, for those of you who are technical analysts and you've seen things like the relative strength index, RSI, think of this as the oversold area, that the PE ratio is so low right now that it looks extremely attractive. And that means that we can expect that some institutional investors will probably start to pile in after they get a chance to, get Tesla at such a good value point. Same thing for price to cash flow. Same thing for price to sales. Price to book is also low. So the only thing that's not looking so great is the price to earnings growth, or PEG. But that makes sense because, as they just said, they're not expecting their earnings growth to be so great. So in short, this is at a good value point, but we have to understand that probably growth of the company's earnings is not going to be as robust as it's been in the past. But given all the situations around the world in this recessionary environment, they're still doing very well. So this is I think this is a safer place to be than a lot of other stocks. Now, as far as fundamentals, just briefly, the numbers here on growth are great. Net income's up 52.18%. Sales are up 15.55%. This is looking at the trailing 12 months. So these are good numbers. Earnings growth is looking good on a quarterly basis. I can clearly see that these figures are getting taller. These histograms are getting taller, which means that the earnings growth is increasing. The earnings are increasing. And if I look at projections into the future, 2022 is still projected to be a solid year for Tesla, better than 2021. And 2023 is also expected to be better than what people are projecting for 22. Now, having said that, there are always bears on Tesla. Just to be clear, Tesla is one of the most contested stocks in history. You always have people that hate it. But the point is, even though the lowest estimate is that Tesla is going to be at $250, I would just point it this way: chances are that's not going to happen. Reason why is because when it comes down to it, growth stocks in the technology sector are the ones that most big investors want to be part of. If you got a company that has a track record as long as Tesla's of actually building value and building customer loyalty and building revenues and profits, it's kind of a no-brainer. I mean, that would be like people abandoning Amazon 20 years ago. I mean, no chance. They were seeing the growth potential, and they're all rewarded now. So the current median price projection is that Tesla's worth about $200 a share more than what it is now at 9/11, and the highest projection is 1580, which I do think that's a little outrageous. But my point is, if we just take a reasonable perspective at the average, I think that realistically this stock has about a 30% upside in the near term. So Tesla looks great to me. And with them taking good financial responsibility of taking steps, even if they're unpopular, to protect the value of the company, I think that's a good play. Also, I should mention that Tesla is going to have a stock split, another one. So this company's had this will be the second stock split since they've had two, and this will be the second one since 2020. And they're not it's not settled yet. They're going to vote on it, I believe, in August of this year. But if they do it, it's going to be a 3-for-1 split. So that means that the shares will be broken up into three pieces, and you'll basically get the price adjusted equivalent of whatever the price is at that time. So if the price is $900 at that time, then you'll have three shares worth $300 each, basically, instead of one share that's worth 900. That makes this more attractive. Tesla has typically been a very attractive stock for people to buy. The only thing is it tends to be cost prohibitive. It keeps going up in price so fast. But every time they adjust the price lower, you usually get a wave of buyers trying to get in while they can. So I wouldn't expect any different this time around. So in short, I do think Tesla is a good value proposition. If you're interested at all in getting into the stock, probably we're at one of the better prices we're likely to see for a while.
And we did a video with the Amazon stock split recently that's been pretty popular. And so from a retail perspective, that definitely allows more investors to come into play. The one thing that I had a question on your Tesla analysis is
Hmm.
the institutional investing. I know that's usually when we go through these,
Right.
there's that helps tell the story. And so what are we seeing from the institutions most recently?
Well, right now, remember the institutional investing. The one thing that's bad about it is that you don't know it happened until days after because they file the reports. They don't file on the same day. So recently, we did see a 0.45% increase in institutional ownership, but we had 213 fewer buyers and 299 more sellers. But Tesla was added to 60 more top 10 lists. So this is a mixed bag when it comes to this, but the system is giving the lion's share of interest in its ranking to the fact that institutional ownership as a whole is up. So that means that even if some funds are selling their shares, and you know, or you have fewer buyers that are accumulating shares than you did before, the key to understand is that those who are buying so much more than those who are selling that they still have a net positive. And it's been added to 60 more top 10 lists, which is proof that the actual increase in assets and money that's been put into the stock has been substantial. So that means that we know institutions are getting more shares of Tesla, and it makes sense. On the money flow, it is in the green. We had a lot of heavy buying on June the 17th, or 16th, 17th. And this is not surprising because a lot of stocks actually saw some serious buying on that day. And I've been tracking the ones that had the biggest jump, and Tesla's one of them. So, in short, we know that there's some buyers that are buying right now. We'll just have to wait for them to actually disclose fully who bought. And we did have a long weekend, holiday weekend. So, some of those reports will be coming in probably towards the end of the week, and then we'll know who bought more. And then once we know that, we'll get a pretty good picture. But I'm surely expecting that the institutional score is going to jump to green pretty soon. And as soon as we see that, that's when we are confirmed that those buyers we were anticipating are coming in. So the way that I usually play out a scenario like this is I will get into some of a position first in anticipation, just to have my foot in the door. And then when I see the outcome that I was expecting, then we start to add more into that position. So for those of you who want to kind of get in a little early, I would say just kind of get in with some part of what you're looking to do, but you can always add more. Now, of course, we're not investment advisors, so I'm just being clear. I'm just giving my opinion about this. But what I will say clearly is that based on the numbers of what the software is showing us, this does look like a good opportunity. So I'll be definitely looking to put on some positions in Tesla. I already had some, but I'm probably going to put on some more based upon this.
Yeah, and that's not to mention that the product in itself is just uh you know revolutionary, and it's really solving a big problem that we're dealing with. And Elon Musk is a pretty good leader, that he knows what he's doing. So love the analysis. Two yellows, two greens, kind of in that mid tier for us. We'll keep an eye on it, but there are a lot of valid points as to why one should consider at least putting it on the watch list. So Tesla is on the board. Moving on to our next symbol. This is one that's been in the news recently, mostly because it's potentially a buyout contender, and that is Spirit Airlines. Ticker symbol SAVE.
Yep.
Save.
Save. So a little quick background here. So Spirit Airlines, I don't know if any of you guys have ever flown Spirit Airlines. They're pretty on the low end.
They're the
their
worst.
budget.
They're the worst of the worst. And they always get you with the bags, right?
Yes, the bags.
You gotta pay.
You got to pay the bag. Yep. So they're not exactly known for being luxurious, and they basically are just like, hey, you went in, you got to pay for everything, but if you want to go as cheap as possible, that's the one you go with. So I've flown Spirit before. It was interesting, I'll say that. But the point is, they're a budget airline, and in the current environment, budget airlines probably are a good place to be, because obviously with fuel prices up, and with people having less money to spend, saving money on travel is definitely a big plus. So Spirit was already approached by Frontier, which is another budget airline company, and they were going to merge in a combination of stock and cash. So, folks, the way this works is the two companies would combine into a new stock symbol, or they would just assume one stock. So I think Frontier was going to be the name still, and then Spirit was just going to be incorporated into it. So that would mean that the shareholders of Spirit would get stock, and some of the stock given to them for Frontier, as well as some cash as well. Then Jetblue came out of nowhere, and they made a counteroffer. And this kind of caught everyone by surprise. Jetblue is a luxury end of the spectrum, and Jetblue basically said, "We'll give you $33.50. That's their current offer, their current bid. They offered to buy Spirit for a save for $33.50. So let's look at this on the platform. Let's get a feel for what's going on here. So presently, this stock is at $23.52. So that's a huge upside. If this deal goes through, you're gaining about $10 a share, right? So on a $20-something stock, that's great. So why isn't the stock trading higher, knowing that that offer's out there? Well, the reason is because there's skepticism about whether or not that deal with JetBlue would pass regulatory scrutiny. Now, if this had happened in the last administration or even the one before, I would say probably there wouldn't be anything blocking that deal. And the current administration has made it a point to kind of go against these mergers and things like that. So there is a serious doubt that it will get through, the regulatory hurdles. And also, there is a serious concern, which I don't think is that big of a deal, that JetBlue is a luxury, and then they merge with Spirit, which is not, and that would give them a much bigger market exposure. I think it's a little overreach to really be concerned about that because let's face it, there's other airlines out there that people can fly that are very popular, like Delta, American, etc., United. So it's not like JetBlue would have a monopoly just because they got Spirit Airlines. You still have Southwest. You still have other brands of airlines that have their own unique flavor and their unique benefits. So, in short, I don't think that it makes much sense because if you merge two budget airlines, you just have one bigger budget airline, which to me is more of an antitrust concern than maybe something that's splitting their interests into two different segments of the industry. But I'm not a regulator, so I can't say what they're going to think. But in short, both deals have been insured, you would say, by the companies that are doing the approach. Both have offered an incentive that if the deal doesn't go through, they'll pay the shareholders of Spirit a certain amount of money in compensation. So it's not a you can't lose situation for the shareholders, but at the same time, in both offers, they actually seem reasonable. So the expectation is that there's going to be a vote held at the end of this month to determine if either deal is going to be taken at all, and if either is going to be taken, which one is going to be accepted. Obviously, if they accept the JetBlue offer, the share price of the stock will immediately go up to nearly 33.50. If they don't accept that offer, that's going to keep the stock closer to where it is now because the deal with Frontier is a combination of stock and cash. But the board of directors of Spirit want to go with the Frontier deal for whatever reason. My guess is that they must have some incentive to do so. On the other side, the shareholders, lawyers are basically that were asked to analyze the deal have strongly, very strongly said that they should go with the JetBlue deal, not the other one. They said it's actually a better prospect. So we don't know which way this is going to run. So in short, if I'm looking at this on the screen, this company Spirit, I mean, it's suffering fundamentally. Let's just face it; they're not doing so well numbers wise. Earnings, of course, dropped off a cliff in 2020. 2021 improved. They're expected to lose money in this year, and so far they have been, but they're expected to make money in 2023 and kind of get back, recoup some of their previous glory. But airline stocks are not usually stocks that people want to buy for growth because usually they don't grow that much after they become established. A technology company usually will. Airlines always have to compete with everything. You got, labor issues, you got fuel issues, you got all sorts of issues, regulatory burdens. So airlines are a tough business to begin with. So therefore, investors long term, my guess is that probably this would be more something that just a regular long term investor might like. But anyone's looking for growth, we can't expect but so much. But analysts are fairly positive about this company. The highest estimate is at $40. The median is at 30.56, which puts the median price target just below the projected buyout, the proposed buyout price from JetBlue. So that does line up pretty well. So in short, if I'm looking at this one, I would say probably the stock is going to be able to hold its ground where it is now. I don't have any expectation that suddenly Spirit Airlines is going to fall off a cliff. It'll probably be able to stay in the same price range it has been over the last month while this deal is being mulled over. Recently, it's been on the rise. So if the deal falls through for, let's say, JetBlue, and they go with the Frontier deal, well, still works out. The price probably will not go up, but it'll still work out. And if the JetBlue deal goes through, then of course the price goes up a lot more. So as long as you're comfortable holding a company like this, knowing that fundamentally it isn't growing that much, it is losing some value because of the current hurdles that it has to overcome, but you are willing to accept that risk. Also, given that the lowest price estimate for this stock is above where we are now, probably it's going to be able to sustain itself. So I think that that play to just buy it and hold it through that meeting probably wouldn't be a bad idea. Worst case scenario, you end up holding a stock that's probably going to be around for a while and has people actually wanting to buy it out. Best case scenario, you make a really quick gain, probably about 40% on your money in a short amount of time. One last thing, if we look at it from the institutional perspective, an 8.22% increase in institutional ownership. So clearly, some people are believers. We have 58 uh, less buyers, we have 57 more sellers. It is in two fewer top 10, so now it's a no top 10 list, which again I've mentioned is not likely to be because it's not a really growth oriented company. But a lot of institutions apparently are owning it for other reasons. And my guess is that it's because of this expectation that some sort of merger is going to happen. The deals are on the table. They just have to say yes or no. But I'm pretty certain one of these deals is going to go through. And if it's the JetBlue one, you get the big jump in price. So that would be attractive. So if you're comfortable throwing some shares into that to hold, you have to put your portfolio at risk, but you want to put a small allocation into that. I would say, in my opinion, that's a reasonable risk to take given the situation. And if it turns out to be a big win, great. If it doesn't, you're just holding the stock just like you would if you were holding any other stock.
Yeah, phenomenal insight, Mike. I just remember flying Spirit once, and then afterwards telling myself I am never gonna fly this airline ever again. So
If you can make a little money off it, that'd be great.
right. So hopefully they're making a merger might improve the experience. But in terms of the analysis, I do have one question.
Mhm.
What is a reasonable time frame for this deal to work itself out? Are we talking a couple weeks? Are we talking by the end of the year? What are you sensing?
The vote most likely is going to come by the end of this month. So we got about 8 days. I think the latest will probably be in July. I don't think this is going to get dragged out. Here's the reason why. Mergers don't usually get dragged out for very long. If no one's moving, then eventually someone's just going to pull the offer off the table and move on, right? So at this juncture, there's definitely offers on the table. They've been working since I believe February at the earliest. So these are on the table. Deals take a while, but the fact that people have been considering this JetBlue offer tells me that there's definitely a possibility it may go through. If it does, like I said, that would be a pretty big jump right away because that's an all cash deal. So they'll just buy out the shares at $33.50, and if you own them at $20, then immediately your value of your position goes up. It's not a no risk scenario. Just to be clear, for all those who are listening, it's not like you can just throw money in this and nothing can go wrong. But what I'm just saying is most likely the stock's going to be in the same general range it's been in recently, and that actually brings me to this. So I have a bunch of stuff on the chart right now. I'm going to get rid of some of them for to make this a little easier to see. So this is one of the best tools that we've added to the Madison platform. And this is something that I've been using for a while, but we had to program it in to the software. So what this is, it's a prediction of what trading range the stock might be in if it goes maximally up or maximally down at any period of time. So if you notice, these bands are always there. They don't disappear. They don't go away. They're always there. And basically, when the stock gets to the top of these areas, usually it only takes a while before it can't go any farther, and then suddenly it comes back down. Or if it goes below that area, stays there for a bit and usually comes back up. Now, right now, if we look at Spirit, it's still well within the boundaries, but it's pushing towards the top. This is one of the reasons I said that you can't really expect this to go up that much. It's not a growth stock. It's not really on a trend up. It's just going sideways. This is basically the range it should stay in. Now, obviously, you don't want to buy it at 23 and have it at 6, and it goes down to 16. but at the same time, at least we have an expectation of where it should be. So this kind of tells you upfront how much risk you can expect to have to endure at the most if you were to buy up here. So ideally, you want to buy towards the bottom end of this range or in the middle. You don't really want to buy towards the top. But in this case, you pretty much don't have any choice because there's a limited amount of time. The market's going to tend to hold the stock up until this deal is confirmed. So therefore, looking for that big pullback right now is unlikely. But for those who are aware of this early and they knew about these deals, which were known some time ago, this was a great opportunity to be able to cash, to get into it. Where now, worst case scenario, you're probably just going to get in at a good price for the stock. Best case scenario, you get this, this big run up, or and then maybe more. So in short, these bands are based upon information that we glean from a variety of information, including options information. And since options data is always looking forward into the future, we're using that information as well as others to make these projections. So it's a very powerful tool. And again, it's not based upon, it's not like some people, when they see this, they think it's like a Bollinger Band, but it's not that. A Bollinger Band is based on a different principle. What this is based upon is an actual forecasted, pre-existing expectation of where the price might be in the future. So once you get to one of those extremes, there is a strong tendency for a stock to get pushback once it starts to get to the extreme top or extreme low. So this is a timing tool that we like to use to help us to know when is the right time to get into something that we're interested in. So when I'm looking at stocks like Tesla, for example, Tesla presently is trading towards the bottom half of that range. And that's one of the reasons I know it's an attractive area to look for. We already hit that bottom area before, and then we finally came off of it. We came close to it again. Now we're still up. So it doesn't mean it can't go down. It just means that if we're going to buy it, I'd rather buy it in the lower half than the upper half, because at least I have a better chance of getting some good upside potential going forwards. So this is one of the nicer tools that we use. And also, if we look at this line down here, which we mentioned in a previous lesson, this line is showing us the score, these 4 boxes. If I'm seeing this rise as we're hitting the bottom of this area, that's a great sign, because that basically means that the fundamentals, et cetera, are improving, even though the stock is down. So it's only usually going to be a matter of time before you start to see it move up. So in short, we got a pretty nice looking picture for Tesla. And for Spirit, it's not so attractive, but since it's a situation based conditions, it's a little different that the way we would manage that.
Yeah, I'm a big fan of the Bollinger Bands myself. So seeing this variation, I'm loving it. And so, real quick, how does one add that to the chart? Because I didn't see exactly how you did that.
Well, mine is already set by default. You have my pattern chart, but the way I do it is I go in here and I'll just scroll down to this one. Now, it's going to be named differently in a second. That the programmers have to rename it, but it's going to be called the Madison Volatility channel. But basically, this is it. So I just clicked on here, and then it adds it right to the chart. This is, again, one of the primary tools I use. I have a lot of friends that I've introduced to this who love it, who trade professionally. So it's one of those things where once you've seen it for a while, you really start to grasp the power of its predictive capabilities, and it also, again, makes it much easier to time entries. I should mention, for people who become members, I do regularly do training classes where I explain how to use these tools, at least at the fundamental level. And then for people who want to be more advanced, I also give more advanced lessons for those who register for those, to be able to teach them how to be even more effective at using these tools. So make sure, if you when you sign up for that trial of our software, guys, make sure that you ask about how to get access to these training sessions, where I actually will explain how to use these tools and give examples of that, so you guys can see the best use of that, and then go from there.
Yeah. And we just added the link to sign up for that in the chat. So if
Thanks.
you found any of this information helpful, as I always do every episode, learning so much about the platform. I mean, there's so many features and tools that, I mean, we've got so much content to work with for the upcoming episodes. But
Yep.
loving it, seeing a lot of the potential, loving seeing the growth and the enhancements in the features. You got a amazing dev team over there. So once again, if anybody's interested in test driving the Madison Trading House software, the link is in the chat. Sign up, ask about the walkthrough with Mike. And that kind of brings us to the end of the show here, Mike. Heading into the midweek. I suppose we're going to continue to listen to Jerome Powell's
Yep.
statements today and tomorrow.
Yep.
Anything else we should be keeping our eyes on?
Other than that, we do have another Fed member, I think Bullard, speaking on Friday. We do have unemployment numbers coming out later this week, but I don't think anyone's really focusing on that right now. And I think the real focus is going to stay with inflation and what the Fed's doing. So everything else seems to be secondary. But at the same time, if the unemployment numbers come out poor, that would be evidence that the economy is weakening. And the Fed does not seem like they're going to back down on their position on dealing with inflation. So therefore, I think that would put some more negative pressure on the market. So we'll stay tuned. But I will throw this last little insight in on the chart. As of right now, the SPY is trading below the lower extreme of this projected range. Now, for me, that's a huge deal because I know that usually this doesn't last for very long, and eventually we see the market come back up. We may get a surprise this time around, but it's not statistically, it's unlikely that we will. Probability is very high that we get a rebound. So before we came into this week, a lot of people asked me that question. I mentioned that probably would see a rebound after the holiday weekend, which we have so far. How far up it will go, not very far in my opinion, but at the same time, this is a good way to get prepared for each week to kind of know where things are at and anticipate these swings in price. So usually the markets will move, even if the Fed says something, they'll still be able to move in the upward direction. But as long as Powell doesn't come out and say, "Hey, we're going to raise interest rates by 200 basis points next month," as long as he doesn't come out and say something like that, most likely we get a bit of a rebound. But folks, remember the bias is still down, and you have to really look for stocks that are in good positions to appreciate in value at this point. And the software, through its scanning capabilities and its screening capabilities, will make it much easier for you. So make sure you take that trial so you can check it out for yourself, and that way it can help you find some stocks, can help you weather all of this volatility.
Yeah, and if you have any questions along the way, reach out to the Madison team. They're there to help answer any questions. If you're enjoying the content, the stream, hit that like, hit that follow, hit that subscribe button. We are doing our best to bring you wonderful content week in and week out so that you can win as a trader and investor, because the opportunities are there. The tools are at your disposal. And so, Mike, thank you for your insights today. With that, we're going to go ahead and end the show and catch everybody next week. Appreciate everybody's time. Thank you very much, guys.
Thanks, everybody. Thanks.